Hi everyone, it's Edward, aka Deadly Crypto. In this video, we're going to be talking about using indicators as confirmations. In today's lesson, we're going to be talking about the RSI, which is the Relative Strength Index, the MACD, which is the Moving Average Convergence Divergent Oscillator, the ADX, which is the Average Directional Index, and I'm going to include exponential moving averages, although some people just use moving averages. So here we can see now price action on the top reflected in candlesticks, and the RSI down below by this purple trend line. The RSI is the Relative Strength Index. I'm not going to go too far into the technical history and background of this indicator, but so that you know how it works, generally speaking, when the RSI index is over the 70 band here, price is considered overbought or expensive. And when price is trending around this 30 band, the lower range, which most traders use 30 and 70 as the upper and lower range. When price is down here in the 30, it is considered oversold or cheap. So if we're using the RSI to decide if we want to enter the market or not, we have to first decide if the market is considered overbought or oversold. Right now, the market is considered generally pretty oversold as the RSI is trending at about 30. This means that we can start to look for entries for a long position. If price was trending in the area of 70, that means we can start to get ready to look for areas to take a short position. As we can see here, when price gets too high into this range, candlesticks start to reflect that in a negative direction. And when price starts to get into this lower range, price starts to reflect that in a positive direction. Now, sometimes you have this area where it trends very high and price continues to accelerate. And that happens again in the lower range as well in some scenarios. However, in this setup, we're looking to see what we can determine right now to see what kind of trade we might want to take on Bitcoin in the near future. So if we're trying to enter this area for a long, we're going to need to find support again in this zone and hope that we can get a retest of this outbreak. The RSI currently supports that price is oversold. So that means we can we can use the RSI to confirm that this is a good area to start looking for a long position or accumulating coins to go long. Now we're going to be looking at the MACD. We're going to keep the RSI on there and look at the MACD as well. So the way that the MACD works, whenever price is trending in a downward direction like this, where the signal line comes under the MACD line, you can consider this a downtrend. When the signal line is trending above the MACD line, that generally means you can consider it an uptrend. So when the columns spill underneath the histogram, that is considered a bearish cross. And then when they flip over the histogram, it's considered a bullish cross. So here we can see in this example, this is an extreme example of a bearish cross. We had a bearish cross right here, and the candlesticks fell down very sharp, so price action reflected that bearish cross very strongly. Here we have a bullish cross, but it doesn't reflect so strongly in the candlesticks, although there is some upward movement from that bullish cross. It's not as tremendous as our downtrend movement was, so there was 16% profits, which would make anyone happy. And a 3-day movement is very good, very pleased. That's 2 years worth of traditional investing right there in 3 days, if you knew how to read the MACD signal. And again, if we're looking at another extreme obvious example where we have a MACD cross, so here's a strong MACD cross, here's also a MACD cross. You can measure from the MACD cross. This is a strong one. We have long 18%, and then even to the next bullish cross 23% on that short, so very strong technical indicator. Right now what we're observing is a bearish cross. We had a bearish cross recently, and price is reflecting that. As we can see on the daily time frame, there's an active bearish cross. Now something that's interesting, if we zoom in here, we are noticing not a lot of extensive drop in the next column. So generally whenever this type of behavior occurs, we see drop, and when there's a smaller movement in the column drop, it can possibly turn back up in reverse direction. Sometimes we get this double or triple bubble event, as I like to call it. That's not the official term for it, but sometimes when looking at it closely, you will see that that can occur. So this is technically a bearish cross, which would support a valid downtrend. That doesn't give us many reasons to go into the long here. So this indicator does not agree with our idea to go long. Now moving forward, we're going to be looking at the average directional index. So this is a momentum indicator. It's not as easy to read as the RSI or the MACD if you don't know what you're looking for, but we're going to go through that real quickly. So what you can see here is whenever the ADX is generally in a low point or under about 14, trending around 14, there's not much of a strength in trend. So we'll do from the start so you can see how these things work, and then we'll pick a few different examples to understand how the ADX moves through and you can read it. So here we can see the ADX is starting to incline, although MACD shows a bearish cross and candlesticks start dipping. This shows an incline because that means the trend is gaining momentum. So the valid trend is gaining momentum, and the valid trend is a downtrend. So that means whenever the ADX indicator starts to move up, the trend is becoming stronger. And in this case, we had a downtrend. So here when we see the ADX is starting to move up again, we have an uptrend. Here when moving up, there's a downtrend. Here when it's moving up, there's an uptrend. So when the ADX moves up, that means the trend is gaining strength, and we can identify this as an uptrend here. We can see some higher highs and higher lows being formed, and that is reflected in the ADX. So zooming back out now. When a trend starts to weaken, the ADX will reverse direction. So here we have a really strong, tall ADX, and then it starts to peak out. Here's not getting any higher, so the trend is starting to turn sideways. Then it starts to fall. So there is no valid trend. We have a consolidation as the price bounces between support and resistance. Here we have another extreme example where the ADX is descending, so that means the trend is losing strength. And then when the ADX is descending here in the candlestick, you can see the uptrend is no longer continuing, and we're starting to go into a downtrend. Now here, the ADX has actually started to gain momentum, and that is a downtrend. So here there was a wedge, as we can see from our candlesticks, which put a slow in the momentum of the trend. Right? This uptrend occurred, and that was counteractive to the downtrend. So we have a strong downtrend, and then a upward burst in price action, which means our ADX goes down. So the valid trend was being negated by that uptrend break. But now we see this sideways movement as there's not much strength in the trend. But here we see the tail of the ADX. It's forming a little tail now as price is starting to move up. So this would be an area of resistance along the ADX. As we could see, it didn't break above here either, nor did it here on that momentum down. So averaging it out now, this trend looks like it could potentially be gaining strength, and the active trend is a downtrend. So we need to be wary of that. So this indicator tells us that we should be looking for more downward price action. So now we've got our exponential moving averages on here. This might look like a lot of information. Now we've got the 9, which represents the past 9 days of information. This is the average price that people were paying for Bitcoin over the past 9 days, this red line here. The green line represents the past 26 days. So over the past 26 days, people were paying an average price of $47,219 for Bitcoin. And the average price of Bitcoin now is $42,000. So what does this mean? This means that within the past 26 days, buyers that bought Bitcoin paid an average of around $46,500 for their Bitcoin. Now if we move forward, this is the 50-day exponential moving average. So it takes the information over the past 50 days. This is the 100 exponential moving average. It takes the information over the past 100 days, and the 200 exponential moving average. So really quickly, a common strategy to use with exponential moving averages and moving averages is the 5200 EMA crossover. So what this means is we're looking for an upwards cross or a downwards cross. An upwards cross is usually referred to as a golden cross. A downwards cross is usually referred to as a death cross. So looking back to the beginning of Bitcoin's time, we can see here there's a strong uptrend on the exponential moving average, 50 and 200 EMA crossover. So here we have a bearish cross. Now, when you're looking for a bearish cross, you want the retest underneath here to prove the resistance is true. We did not get that. We had a bullish cross, so we were looking for the bullish cross to show a retest over the 200, but it was not true. Then we had another bearish cross, and we start to use that as resistance on the 50. Then we see that potential breakthrough, but it starts to be rejected, which confirms that we're in a long-term bear trend. So this is a death cross, and you can see there was a very long period of downtrend action from that bear cross to the next bull cross, which was almost a year. Then we can see a bull cross or a golden cross where they cross over, and then we have confirmed support where this is used as support, so that means there's a long-term uptrend. Then we can see the bearish cross again. We have a little bit of retest, riding it up, bearish cross. So that's a basic strategy that a lot of people look for in Bitcoin and many assets when they're trading across multiple time frames as well. We're still going to get into multiple time frames in another video. So with that information, we have here the 50 EMA being used as rejection, and we have potentially a bearish cross right here. So now naturally there could be some price rebound as price is very far away from the 50 and the 200 exponential moving average. When that happens, naturally there must be some sort of rebound where price strays back into that range. So we could potentially see a rejection here if this comes through with a cross. So including all of the exponential moving averages I like to trade with, I can see that there have been multiple crosses. The 9 and 26 are on a pretty strong and active valid downtrend here, as well as the 50. However, the 100 and the 200 EMA have not crossed. So it's possible this could be a fall through and there could be some swing back up here, which would constitute the bull run to stay in effect. But if not, then we're going to start to use these exponential moving averages to go into this next area of previous support that we have outlined from previous price action. Now this is just what these exponential moving averages are telling us on the daily time frame. So it looks like if we did want to target short, that would be a pretty bad idea as price is even far away from the 9 exponential moving average. So we'll have to wait for it to come back naturally. If we zoom in a little bit closer, we can see here, I'll try to tell you what I'm talking about. Price is along the 9 EMA here. So it could go up or it could go down at this point based off the 9 EMA, which is why we like to use it as the most immediate point for support or resistance. So as we can see here, price is close to it and it has room to move in either direction. Now price is not close to the 9 EMA, so it can't go much further in this direction without coming back for some kind of retest. We'll look at another extreme example where price is moving upwards away from the 9 EMA. It cannot continue to just blast off away from that mathematically. It can't. So it must come back down to touch at some point, and we use it as the first layer of support until it starts to use resistance. So here we can see that it could go either way, but here we see that it's far away from the 9 EMA. So it must come back. It must come back naturally, and it does come back to touch. Then it goes back up and far away. As it gets far away again, it comes back to touch. Then we start to see that flip as it uses it for resistance. The first crossover on the 9 and 26, which is indicative of the short-term bear trend. The 9 and 26 cross happens here, while the 50 and 200 EMA have not crossed yet. On this chart, the 50 is blue and the 200 is orange. So the 50 and 200 has not even occurred yet. You would not even have gotten a bear signal if you were looking at the 50 and 200. But the 9 and 26 did give you a bear signal back on November 18th of 2021. And you could still be using that as valid resistance as price got rejected here again from both the 50 and the 100 EMA. So that downtrend could have showed you that there was resistance here and that it was another opportunity to take a short. Even here, as we see this resistance, constant failure to break above. The candles cannot close above this 9 EMA, so that could have potentially told us to take a short position. So now that you've charted the market structure and you've used indicators to help you confirm or deny your idea about the bigger picture, now we need to get into multiple time frame analysis so that you can see how to apply all of these traits into multiple time frames and find better entries and exits for your trades. So I hope this video was helpful, and thanks for watching.